Hello and welcome to Accredited Real Estate Schools. This is Bryan Church. This is our California real estate market update for April 2022. California real estate continues to be a good investment even as the Federal Reserve Bank, the Fed, raised interest rates by a quarter point, which is 0.25% on March 16th, 2022. Forward guidance from the Fed indicates that it will continue raising interest rates, probably a quarter point to half a point, during every Fed meeting through 2022. At least that's what they're planning. These interest rate increases are in response to inflation. They're intended to decrease the rate of inflation in the U.S. financial markets. So we're seeing some inflation coming in now, and it's running somewhere around 7.5%, 8% on some of the charts and 5 to 6% on some of the other ones. But we're showing definite inflation. So the Fed, in response, has started increasing their interest rates to try to reduce and head off the inflation. As inflation rates increase, consumers should be looking for inflation hedges. Two of the most important historical inflation hedges are real estate and gold. Real estate has traditionally been a good inflation hedge because real estate prices tend to track inflation. They provide income during the property holding period, and fixed rate real estate loans are paid back in the future with inflated or cheaper US dollars. So you pay them back with cheaper dollars in the future. So that's why real estate's been such a good hedge against inflation. Gold has also been traditionally a really good hedge against inflation, and it looks like it may be going up as well in the future. So those are the two that investors are looking at right now. The risk is that the Fed has backed itself into a corner with only result being a recession. If the Fed raises interest rates, then the federal government will pay higher debt service for the trillions of US dollar denominated debt that we've added on to our debt here recently. So they have a real problem there. If they raise the interest rates too much, then you're going to have too much debt service on the huge amount of debt that the United States has. If the Fed does not raise interest rates, inflation may run rampant, reduce the purchasing power of the U.S. dollar, potentially, hyperinflation, and where it really looks like it may be going is stagflation, where you've got inflation but no growth. And this is kind of a look at the discount rate and the federal funds rate. And discount rate's what banks will pay if they go to the Federal Reserve to borrow money directly from them. Federal funds rate typically is banks, loan money to each other. And what happened was it was really, really flat for quite a while, and then the Fed raised the interest rates right after the end of this chart to try to get ready for the next problems that they ran into. And of course, what they did is they raised them up and then they lowered them back down, and now they're going ahead and raising them back up again. And the result is expected to be some type of a stock market correction. And as soon as it gets disorderly, there's a lot of corrections, then the Fed may stop raising these interest rates. But until then, they're probably going to keep doing it every meeting, which is usually every couple of months during the year. So the interest rates could go up quite a bit in 2022. The inflation that we're seeing today is real. It's more cost push inflation rather than demand pull. And in other words, prices are increasing due to cost increases caused by the U.S. government's fiscal policies, like the Green New Deal. The U.S. has reduced fracking due to environmental concerns, so oil must be imported, causing consumers to pay more for gasoline at the pumps. That's what we're seeing right now, where we don't have any demand pull, which is demand. Now this is all costs are going up to do things, and down the road, we could see some demand pull inflation, but right now we're just seeing more the cost push variety. The Russian-Ukraine war has provided Russia with the opportunity to increase global oil prices to their benefit. Excuse me. They also have increased their physical gold holdings to help insulate themselves from economic sanctions imposed by the West. So Russia, which provides a lot of natural resources, that's where they really make their money. Natural gas to Europe, and then also oil to the rest of the world, and they'll be able to increase those rates because of the U.S. Reducing the fracking. So we've done that to ourselves, and so what's happening is Russia's got about 20% of the reserves in physical gold, most of it held in Russia, And so they are trying to insulate themselves from the sanctions the U.S. has hit them, especially with the SWIFT, the communication system, financial communications for banks, which is super critical. And then they're also have froze a lot of the U.S. dollar-denominated assets for the Russian central bank, which is another issue because then they're going to do workarounds to bring in, instead of the petrodollar, they'll be buying gasoline with the yuan and things, which the U.S. doesn't like because we have the world reserve currency because of the petrodollar. We do all pay for all the oil with U.S. dollars since Henry Kissinger negotiated that back in, I think it was about 1974 when he did that. Physical gold has been a good inflation hedge and flight to safety asset in the past. Does not provide income during its holding period, but is easier to store and maintain than real estate and also hide. There has traditionally been high demand for gold jewelry in India and China, where over 2 billion people live. Physical gold has been a store of value for over 4,000 years. So not only is real estate a good inflation hedge, but we also think that gold is also going to be something that's going to increase in value. It'll go up because of the flight to safety. You'll also see gold maybe going up because the Bank for International Settlements, which is basically as all the banks, central banks in the world get together, and they may have a reset using gold backing the currencies. And if that happens, then gold could go up quite a bit more than where it's at right now. So a lot of people are also diversifying into physical gold that they can touch, because remember, you can't touch it, you don't own it. So they stay away from the paper gold, and they would stay with physical. Digital currencies have shown their worth during the Canadian trucker demonstration. However, governments are coming out on their own with their own central bank digital currencies and will not want to share the digital pathways with competing cryptocurrencies. Only time will tell whether cryptocurrencies will be able to maintain a store of value or become exclusive domain of criminals and drug dealers. So what's happening now is the Canadian trucker demonstration. People were paying to help them and being penalized because of that. But the biggest issue is the pathways, because the governments can control the pathways where the cryptocurrencies go. And so we're going to find out if they're definitely not going to want competition for their central bank digital currencies, which the US dollar is already digital. It's just this would be where they would possibly have more digital, less fiat physical currency of cash. Be careful holding too much physical cash, though, because the U.S. government could give everyone 30 days to trade their paper U.S. dollars in new central bank digital currency. That's where gold comes into play. It's no counterparty risk. Physical form, it can usually be held as a long-term store of value, as has been for many, many years. So anyway, that's our update for the second quarter 2022. And so we'll be back in July for our third quarter real estate update. But until then, hang on for the wild ride, because it's going to be interesting to see what happens in 2022 to the not only inflation, but the stock markets, real estate markets, and the precious metals markets. Anyway, have a good day. It's Bryan Church Accredited Real Estate Schools.